Hey everyone, it is Jonathan Wells here, and I'm so excited to be sharing with you some brand new content on my channel where we're going to be talking about all things finance, and what better place to start than the basics and the foundation of building wealth, and where you should really start and finding out what stage you're actually in. So we're going to go over the groundwork, the foundations, the baby steps, if you will, of personal finance. We're going to find out where you stack up and where your next step is. Now, there's a lot of content out there from other influencers like Dave Ramsey or Brian Preston, where they talk about their basics, their baby steps, their financial order of operations. This is my version of it, and I want to share it with you guys so that you understand the approach that I have with my clients on personal finance. So without further ado, let's get into the video. All right, everybody, I'm going to be introducing you to what I call the foundational wealth building doctrine, or the forward, if you will. So this is my personal take on like the baby steps or the financial order of operations. These are the suggestions and the groundwork that I lay for my clients and for myself personally when it comes to managing our personal finances, right? So this plan is designed to guide you through your journey of wealth accumulation so that you stay focused on what's next and how to get there. All right, so this is a step-by-step roadmap, and it's curated for young professionals trying to master their finances, eliminate debt, and build wealth while making homeownership a smart, strategic milestone along the way. So as you all know, I'm personally, in the mortgage space, so I help a lot of people purchase, their first, second, third homes, etc. And a lot of the financial, orders of operations, baby steps, etc. They sometimes tend to neglect, a lot of content around specifically purchasing your first home. So this is one of the reasons why I created this document here, is to help you not only purchase your first home, but also make sure you're being well-rounded along the way as well, in the total financial, money moves that you're making, right? So first one, I want you guys to shield your finances, right? So cover your risks. This would be something like the baby step one, for Dave Ramsey, of having the $1,000 emergency fund, or would be like, covering your deductibles in the financial order of operations. So mini emergency fund, $2,000 to $5,000 to handle some small financial shocks. This is not going to cover, long-term care, anything like that, right? But it's just something to have, for that can cover, most of the big, oh crap type of emergencies that you'll run into. Second thing, we want you to secure essential insurance. So making sure you have things like car insurance, health insurance, renters/home insurance if you already own a home, and disability insurances. So you need to make sure that you're covered on all of those aspects so that, again, you're not digging into your finances further to pay for any coverages that you should have had in the first place. Number three, we're going to be tracking your cash flow. So knowing where every dollar goes, right? A lot of people budget differently. Some people don't even keep track of how much they're spending in each category. They just keep track of the whole of what they're spending. But what I would like you to do is take your last 3 months of statements and just analyze them. Look at them, see what you've been spending money on, total some of the numbers up, kind of see what you're looking at. You'll be, extremely shocked as to what you're actually spending money on, and it'll make you think twice about what you're going to spend money on in the future. A great example of this is, like for myself and my girlfriend, is DoorDash, where, every time, like, I see how much we spend on DoorDash, in a given month. And so now if we want to go get something to eat and she's looking to DoorDash to the house, I will 9 times out of 10 go pick that order up, because you're now paying a markup to DoorDash and you're also paying delivery fees, tips, etc. So again, this is just a great way for you to audit. Some people may need this more than others, if you're a spender versus a natural saver, but it's just good to understand where your money's going and to get a better idea of that, so you're spending with a purpose instead of for convenience. Now, also avoid lifestyle inflation. Keep spending in check as income grows. One of the things that I've actually done personally around keeping my lifestyle inflation low is I actually get my direct deposits sent to my long-term savings account, right? So my high yield savings account, it's got, interest rate of like 4.375% at the time of recording this video. So I actually get my checks direct deposited to my high yield savings account. I earn a better interest rate, and what it allows me to do is send the money that's just to pay my bills through over to my checking account, which is what I really look at, on the day to day, right? So if I have a month where I kill it and I have, a higher than expected income, I'm not spending additional money emotionally, justifying it by saying, oh, I had a great month, because I know around the corner at any given point, I could have a month where, I fall short of my expectations and I actually make less than what I need to survive. So the goal here is to protect yourself from unexpected financial setbacks before building wealth. Now, step 2 is going to be all about leveraging your employer boost, right? So getting that free money. Again, this is another one that, I've kind of taken from other, financial plans. But I really love this because you're getting 100% returns on your money and then some. So if it's available, you're getting a 401k match. It's free money. So if your employer matches up to a 3% contribution and you make $100,000 a year, that's $3,000 in free money, and you get the additional tax savings off of your top line. So if you're making 100 grand, we'll assume that your, taxes are closer to that like 33% range or a little bit higher. So, and you can have state income tax as well. You can be saving. So you could be saving an additional $660 a month or a year in tax savings. So that would be basically a $3,600, boost for you, because you're not paying taxes on that money, and you're able to put that money into your retirement and have the employer match it. So even before you pay off credit card debt, I do like getting at least the employer match, because again, it's free money that you're not going to be able to get, if you can't backdate it. So it's free money that you can get just by contributing to your employer sponsored retirement program. I love this option, even if you're in some credit card debt, because again, it is free money and you can't just go back and get that free money either. So it is a really good opportunity for you to be maximizing the value of the dollars that you have. Now, step 3, we're going to crush that costly debt and we're going to eliminate your financial drains. So again, the biggest wealth building tool that you will have is your income. And so there's really 2 things that I want my clients to focus on if their goal is to continue to grow financially and exceed the highest of expectations. Number 1 is you got to grow your income, and number 2 is you have to cut your expenses. So that's building that gap or building that margin for you to be able to invest. So when it comes to crushing the costly debt, you want to pay off anything that's above a 12% APR. So focus on your highest credit cards first. If you want to do the snowball method where you pay off the lowest balance first and free up that cash flow to then attack the next lowest balance, I'm cool with that too. But again, I would just put all the credit cards into one section, pay those off, start getting that steam rolling. If you need to take, some extra, overtime with your job, delivering DoorDash, whatever you can do to increase your income and build that margin, it's going to help you pay off this debt. We want to avoid any lifestyle debt, like no financing vacations, no financing luxury cars or any unnecessary expenses. I see this a lot of times where, people who have credit card debt that I'm talking to have vacations that they're planning, or, they told me they were on a vacation when we first started the process. And then before we closed the transaction, they're on another vacation. And it's always been interesting to me seeing that. Like now at least I'm in a slightly better financial position than I've been in before. And I don't take vacations like that. So another thing we want to do is avoid lifestyle debt. So we don't want to finance vacations. We don't want to finance luxury cars and any unnecessary expenses. Personally, I believe in having one car payment per household. So if it's yourself, okay, you have one car payment. If you're with you have a significant other, spouse, whatever, there should be one car payment between the both of you, while you're living under the same roof, in my personal philosophy that I use for myself. And it's just crazy to me too. Like a lot of people that I talk to that are in debt, they're financing vacations on their credit cards that they're being charged 25% on, which I think is just a diabolical idea. For me personally, like I've seen clients that are in credit card debt take multiple vacations per year before sometimes we're even closed out on the transaction, and they were on vacation when I initially talked to them. And it's just funny because I think I take like maybe 2 or 3 vacations total per year, and that's kind of stretching it because like last year I did take like 3 different trips, but 2 of them were one was a bachelor party, one was a destination wedding. So I don't really count those as vacations, but I still, it was a charge. And so, it's just interesting where, I don't really take many real vacations. A lot of the traveling I do personally is for work, but again, don't finance the traveling, don't finance the vacations, keep luxury car purchases away from yourself in this stage. You can buy a luxury car later on, but right now, I would definitely recommend putting that money towards something that's going to help you increase your net worth as opposed to decrease your net worth. And then last one is manage student loans wisely. So keep payments reasonable while progressing towards your financial goals. Depends on, if you've got $50,000 in student loan debt, then I don't really think that it's advantageous for you to pay that off first before you go into the next steps. However, it is, you just manage it wisely. Don't worry about paying it all off right now, but also don't not make a payment or have any kind of negative amortization on that loan. So the goal here is to free up cash flow and break the cycle of expensive debt. Now, we're going to break up step 4 into 2 parts. So we're going to have part 4A, which is building your emergency reserves. This is going to be above and beyond that initial emergency fund you had of $1,000 to $5,000. This is where you're going to fully fund that 3 to 6 months of your emergency expenses. And this is going to be your bare minimums, right? Your car payment, your water bill, your grocery bill, if you're living off of beans and rice and ramen, and then making sure that your housing is taken care of, etc. So for most people, your survival number is probably going to be between $3,000 and $5,000. Most likely. So if you're 3 to 6 months, that's anywhere from $9,000 up to, 15 grand, typically somewhere in there. But it allows you to make bigger moves in the future without risking going into debt. So the last thing you want to do is, crush your momentum by repeating the cycle, going back into debt, maxing out your credit cards again, etc. And so the goal is to ensure your financial security before you're investing aggressively or buying a home, which is step 4B. So step 4B is secure your home with a smart and strategic homeownership purchase. So save for a down payment of above and beyond that 3 to 6 month emergency fund. Personally, a lot of my clients that I talk to, they spend on the low end around $10,000 to get into their first home. On the high end, $30,000 to $40,000 to get into their first home. So what I would recommend is, let's say that your emergency fund is, or your expenses are $3,000 a month for bare bones necessities. Personally, I would tell you to have about $9,000 and then start saving for your down payment, because that 3 month survival number is usually good enough for you to get in. And again, so you have a total of $19,000, you're set. A lot of people will also pull their down payments from their retirement accounts as well that I've dealt with. I don't hate this option. There are provisions in the tax codes for using that money as your down payment. Just be careful when you do it, because it could eat up, some of that growth potential in that account. So for example, if you found the right home and you wanted to purchase it, and the only way for you to buy it right then and there is pull money from the retirement account, and you have to do it, I just wouldn't put down a full 20%, because again, the taxes and the penalties you'll be paying on that money that you're pulling out, depending on what accounts you pull it from, could leave you with a sizable dent in those accounts in the future. So just be aware of that, and talk to an expert like myself who can walk you through how to do all of that with as little tax implication as possible. Save for a down payment, boost your credit score. This is going to go hand in hand with paying off those debts that you have on your credit report. Understand mortgage basics, right? So looking at the differences between FHA loans, conventional loans, interest rates, property taxes, etc., and be financially ready to handle homeownership costs. So once you close on your home, you'll need to increase your life insurance at a minimum to a term policy that covers the mortgage balance, as well as potentially investing in big ticket items to complete your habitat. Things like TVs, couches, furniture, etc. You're going to need, I just had to buy an electric charger for my garage, which was another $600, so that I could charge my car at the house and save money that way. So there's a lot of different things that you'll go into that you'll end up spending when you do purchase the first home. And so again, making sure you get your additional insurances covered, etc., is super important. So the goal is to buy a home when it aligns with your finances, not just when you're approved for a mortgage. A lot of people that come to me that can qualify, but I tell them, realistically, you're $30,000 in credit card debt. I would work on paying off the credit card debt first and then going into a home that you can purchase. Now, again, it's your money, it's your choice. You're going to do whatever you want to do, and I'm here to help you with that. But my personal suggestion, if it was me, I would want to take care of the credit card debt so that I'm not continuing to dig the hole that I'm going to be in financially. So step 5, we're going to look at tax advantage wealth, right? The reason why I put this after purchasing a home is because, in my personal opinion, owning a home is one of the fastest ways to build wealth. It's one of the reasons why I have the net worth that I have today, is because I made 2 really good real estate purchases, and I made, a lot of money off of those real estate purchases when I bought them. Part of it was the inflationary times that we were in when I purchased those properties, but what really did it for me is the fact that I didn't have to pay taxes on those gains when I sold the property, because I'd lived in the home for 2 of the last 5 years and it was my primary residence at the time when I sold it. So, that's why I really like the real estate section first, because again, it allows you to get, equity in that property and to start riding the market up, which, with an investment of the size that you're going to be purchasing when you do buy a home, your even a 4% gain is going to be a significant increase in value that is tax-free when you do decide to sell it. You can borrow against it if you'd like to. Just a great option. But outside of that, you've got your things like Roth IRAs and HSAs. So what I would do is look at opening to funding a Roth IRA. It's tax-free retirement growth. You pay taxes on the money today. When you get it direct deposited from your employer, you then invest the money. It grows tax-free. You're all set. For those of you who don't, or who make too much money to do an IRA or a Roth IRA, you could look at a backdoor IRA with a financial advisor, or you could max out your 401k as well to help save you on those tax implications. And then an HSA is health savings account if eligible. It has a triple tax advantage and it gives you more medical savings. So the goal here is to grow wealth with tax advantage accounts for maximum efficiency. So a lot of people that I talk to, if they're debt-free, paying down their house, this is the step where you really need to make sure you're maximizing this. I know it seems really sexy to pay off your home as quickly as possible. And trust me, I don't really care. As a mortgage lender, it is one thing that people have this misinterpretation of, is that I, want you to keep a mortgage for a long period of time. Personally, I don't really care because I get paid when the deal closes and that's it. But I would make sure that you're maximizing your retirement investments, because again, this is what's going to actually set you up in the future. Owning a home is giving you that bonus cherry on the top of having that equity and having it be tax-free. And you can lock in your cost of living. It's not going to go up year over year aside from minimal taxes and insurance increases. And you're going to be able to eventually have that paid off. And then you have no housing expense from there outside of your annual taxes and your annual home insurance that you should still have. Now, step 6 is a little subset of step 5. It is maxing out your retirement long-term security. So continuing to max out your 401k contributions. As of 2024, the maximum contributions was $23,000 plus a catch-up if you're over the age of 55. So as of 2024, the limits of a 401k contribution was $23,000 plus a catch-up if you're over the age of 50. Now, it also increased your contributions to your Roth IRA and HSA depending on the tax bracket that you're in. This is your opportunity to take full advantage of the fact that these dollars will grow tax-free in a retirement account that can help you manipulate your tax burden. And so if you're wondering like which buckets you should be throwing money into, it's definitely where I would recommend having a conversation with, a financial advisor, or even someone like myself, where I'm not a licensed financial advisor by any means, but I can point you in the right direction and give you resources that you can use to continue to look into these and have, and build your personal strategy. And so the goal here is to ensure a well-funded retirement and financial security in later years. And we have step 7 here, which is the wealth accumulation. Now we're really starting to cook here with step 7. This is for the real high income earners. You're already crushing everything at work. You're getting paid. You're paying off your house. You have all your debt paid off. You're investing. You're maxing out all the different retirement accounts you can have. Now this is where things really start to get interesting. So you're going to be supercharging your finances and you're going to increase that savings rate. So strive for 20% of your gross income. If you can go above and beyond that, man, my hat's off to you, right? If you're saving, even if you're saving like 50% of your income, I've seen people do that before. It kind of goes hand in hand with what I talked about earlier, where you're not only decreasing your expenses, but you're increasing your income. So these are going to be people who are making well into the 6 figures, maybe even above $200,000, or even a household income where you're making $200,000 plus. You keep your living expenses low. You've got all your debt paid off. You really just have a mortgage at this point. You're maxing out all your retirement accounts. Let's now continue to play this game where we can continue to sock away as much cash as possible. So investing beyond the retirement accounts, things like brokerage accounts, real estate for like rental real estate, side businesses, etc. And you can develop additional income streams with this as well. Just feeding that hamster wheel and continuing to build up your income while maintaining your expense level is really going to help you with this too. And so the goal is to move from your financial stability to a rapid wealth building and financial independence. So this is going to be things like growing that side business, maybe buying some rental real estate to help cash flow and increase your income there. These are real investments that you're making that can actually pay, somewhat of a dividend or a monthly reoccurring revenue that you can then use to continue to accelerate your financial gains and potentially buy more properties or more businesses that are going to continue to add cash flow to that fire. Now, as you're developing those side hustles and those other ways to grow your money, you can now prepay future expenses. So these are strategic planning. Now, step 8 is really where you start to get into legacy planning, which is where you're going to prepay future expenses. So these are things like saving for larger expenses, kids' college, big purchases, etc. And also optimizing your financial plan for the long-term goals that you have. So this is really where, it would make sense for you to bring in a financial advisor and have a more detailed conversation about making sure that everything is continuing to be efficient, because this is a time of life where most people, start to hit their ceiling for, what you can really Google, which, I believe that anybody can learn anything, but having an expert in your corner is really going to help you take full advantage, of the current situation that you're in. And so the goal here is to plan ahead so your future financial needs don't derail your current progress. And finally, here we have step 9, which is your financial freedom, making work optional. So at this point, you've paid off the remaining of your low interest debt, things like student loans, mortgages, etc. You've built generational wealth, so with what you currently have saved and invested, it's going to grow to X amount of dollars. That's then going to be able to pay for your kids, it's going to be able to help supplement your kids, your grandkids, your great grandkids, etc. And you've achieved a work optional lifestyle, meaning that maybe your passive income investments are actually paying you more than what your current job is. So this would be great. Like, let's say you make $100,000 a year and you're actually cash flowing an additional $100,000 a year from rental properties or businesses that you own or anything like that. This is where you make your actual employment optional. You can decide, hey, I don't want to work tomorrow. I'm going to retire. I'm still making the same amount of money and I'm still investing. I'm still, buying up some different properties, etc. But you make it optional. You don't have to do anything. You could retire and, move on to the next stage of your life. So again, the ability is to not only be able to retire early, but more so to work on your own terms. So this is a stage that I'm excited to get to myself, where I'm really only doing the things that I want to do, which would be making content like this, meeting with exceptional people, and brainstorming and having great conversations. So the goal here is to gain full financial freedom and live life on your terms. Now, here's some next steps for you all. If you want to know more about how you can get started, please send me an email at educatedlend@outlook.com, and I can get any questions you have around these basic steps here featured in a future video. I would love to hear from you, get feedback, anything like that. And lastly, you are equipped now with the financial knowledge to dominate your goals. So go after it, achieve your dreams. Please like this video, subscribe, leave a comment, send me an email to get your question featured, on my Q&A sessions. I cannot wait to connect with you more. Until then, Jonathan Wells signing out.